If you are serious about building wealth in the Indian stock market, ETFs can be your most powerful tool. But here is the problem. There are hundreds of ETFs listed on Indian exchanges, and most investors have no idea which one actually deserve their money. Today, I am going to cut through the noise and give you 5 ETFs backed by verified data. And these are not random picks. ये research backed selections है with concrete numbers that you can verify. So let's dive straight into it. Number 1 is Nippon India Nifty 50 Bs. This is your foundation. If you are building a long-term portfolio, you need exposure to India's top 50 companies, and this ETF gives you exactly that. Now I know what you are thinking. हर AMC का Nifty 50 ETF है. What's special about this one? Here is what sets it apart. Liquidity and precision. This ETF has an AUM of over 56,552 crores with an expense ratio of just 0.04%. That is among the lowest in India. But the real edge, this is one of only 10 large cap ETFs in India with the lowest tracking error of 0.03%. मतलब जो Nifty 50 index return देगा, almost exactly वही return आपको मिलेगा. And this ETF has been around since 2001. That's over 23 years of track record. When you combine ultra low cost, minimal tracking error, and massive liquidity, you get institutional grade efficiency at retail prices. And the bottom line, if you want broad market exposure with zero drama, this is your go-to ETF. And ETF number 2 in our today video is ICICI Prudential Nifty 50 Value 20 ETF. Now we are getting strategic. This is not your regular index fund. This is a value investing approach packed as an ETF. Instead of buying all Nifty 50 ETF stocks, this ETF picks only 20 based on 4 parameters. First is lower PE ratio, second is lower PB ratio, third is higher dividend yield, fourth is higher ROCE, return on capital employed. This ETF has delivered 16.11 annualized returns over 5 years with an expense ratio of 0.25% only. Essentially, ये ETF undervalued companies को target करता है. और here is the key insight. Value factor indexes historically outperformed during market recovery phases. You know what is interesting? अगर HDFC Bank भी इन value criteria में fit नहीं होता, तो ये ETF उनमें इन्वेस्ट नहीं करेगा. That's how disciplined this strategy is. And when to use this? If you believe the market is going through a correction and want to position yourself for the next upcycle, this is where smart money goes. And ETF number 3 in our list is HDFC Nifty Small Cap 250 ETF. And ये है high risk, high reward territory. But if you understand timing and risk management, small caps can create serious wealth. This ETF tracks companies ranked 251 to 500 by market cap. And it has an AUM 1628 crore with an expense ratio of 0.25% only. This ETF was launched in February 2023, so it is relatively new. But that's actually not a problem. What matters is the underlying index and execution quality. The alpha potential here is massive, but only if you have the stomach for volatility. Now here is the critical part. In small cap ETFs, liquidity is everything. अगर liquidity low है, you'll get stuck with bad pricing when you want to exit. According to industry analysis, HDFC's version along with Motilal Oswal shows strong trading activity in this category. And that is your safety net. The HDFC fund is managed by senior fund managers Arun Agarwal and Nandita, who bring considerable experience to passive index management. And when to buy this ETF? When the Nifty Small Cap 250 is trading below its 5-year average PE. Right now, track current valuations against historical averages to find your entry point. And there is only one warning. Don't put more than 10 to 15% of your portfolio here unless you are genuinely long-term focused. And the number 4 is CPSE ETF, Central Public Sector Enterprises. This is a thematic play on government-owned companies. Unique है, niche है, but incredibly efficient. CPSE ETF has an AUM of 28,704 crores. That is massive for a thematic ETF with an ultra-low expense ratio of just 0.07%. This ETF has delivered 33.45% annualized returns as of January 2026. That's exceptional performance. Though past performance doesn't guarantee future returns, ये ETF typically 11 top-performing PSUs में invest करता है. Companies that are backed by the government and often pay solid dividends. The CPSE ETF delivered extraordinary 5-year performance. 34.95% during the PSU re-rating cycle from 2021 to 2024, though it has cooled off recently. Look, CPSE stocks are not always in favor. They move with government policy, reforms, and infrastructure spending. But if you believe in India's long-term infrastructure story and want steady dividend income, this is worth 5 to 10% allocation. And the pro tip is CPSE ETF performs best when the government announces major capital expenditure plans or PSU reforms. Number 5 and the last is Mirai Asset Nifty India New Age Consumption ETF. The consumption ETF from Mirai Asset was recently launched as a new age consumption ETF in December 2024, tracking a new index that focuses on India's evolving consumption patterns. India's consumption story is legendary. Rising middle class, increasing disposable income, growing aspirations. This ETF captures that theme with a modern twist. This ETF was launched on December 2024, making it very new. And as of February 2026, it has an AUM of approximately 41 crores. The Nifty India New Age Consumption Index includes sectors like digital services, e-commerce, FMCG, automobiles, consumer durables, and healthcare services. Basically, companies that benefit when India spends more, especially on new age digital and premium products. With the rise of social media and growing influence of technology, aspirational Indians are now spending more, moving their consumption from unorganized to organized markets, favoring premium categories. And why it is interesting? While this is a new ETF and doesn't have long-term peak record yet, the underlying consumption theme remains strong. As India's per capita income grows over the next 5 to 10 years, consumption will also increase. However, be cautious since this is a newly launched ETF. Liquidity might take time to build up and there is limited historical performance data. We can consider this as a long-term view. This is a 5 to 10 year wealth creation theme for patient investors who believe in India's consumption story. Now, before you rush to buy these ETFs, let me give you the framework professional use. 4 pillars of ETF selection. First is liquidity. Always check daily trading volume and AUM. Large AUM indicates institutional confidence. For newer ETFs, monitor liquidity development over time. And the second is tracking error. Lower is better. Always aim for tracking errors below 0.1% for broader market ETFs. Agar tracking error high hai, it means you are paying fees but not getting index returns. Third is expense ratio. ETFs are supposed to be low cost. The best Indian ETFs has an expense ratio between 0.04% to 0.3%. Don't overpay for passive management. Fourth one and the last is valuation. Use PE ratio to check if a sector is expensive or cheap compared to its 5-year average. Buy low, not at peaks. And the important disclaimer, past performance is not indicative of future results. Always verify current data before investing and consult with a SEBI-registered investment advisor if needed. Now, you have 5 ETFs. Remember, ETFs are tools, not magic bullets. The real edge comes from understanding what you are buying, when you are buying, and why. I have given you the data. Now it's up to you to verify, research further, and make informed decision. And if you find this valuable, make sure to subscribe because we are going to deep dive into strategies, portfolio construction, and market timing in upcoming videos. Market में survive करने के लिए you need knowledge and verified data. And I am here to give you exactly that. See you in the next one.